Well, it's been a while since that I or anyone has talked to you all about the different aspects of the LOIT and the accounting for LOIT, so as a former co-worker of mine told me back when I first started at the Auditor of State's office, when I would come up with these. He was a very knowledgeable man, and I learned a lot from him, and we spent a lot of lunch hours, me quizzing him and him willing to answer my questions, and I would come up with ideas about that. What about you think if we did this or we did that? And Dick would tell me often, he says, now just remember, you bring it up, it becomes your project. So, so you need to remember just how strongly do you believe in this, And so I mentioned that there should be a LOIT presentation, and you look and you see what happened to me. So I'm giving the LOIT presentation. So this is just some basics about LOIT for those who are fairly new that certainly haven't seen this presentation at all, and really I've not given this exact presentation before. This hopefully will help you with questions you might have, either about the LOIT that you have now in your county or LOIT that your county council or income tax councils may be considering for the future. And then for those that have heard this before, hopefully this will be a good refresher. And these are the different types of the LOITs, and what I will be talking about today with the county adjusted gross income tax, CAGT, and the county option tax, income tax, COIT tax. There are two different types on the COIT. You can have COIT counties, which the majority of the COIT counties are this, where they haven't adopted a homestead credit along with the COIT. And then there are COIT counties that did adopt a homestead part of the COIT tax or use of the COIT tax, not to confuse this with what we call the LOIT homestead credit in a COIT county. It's a little bit different than the two are a little bit different. The LOIT, where like I mentioned, with CAGT and COIT, you can have a property tax relief adopted for that, which are your replacement credits, homestead credit, and your qualified residential credit. And then you have levy freeze, and then the public safety. And then I'm going to talk briefly about the seated distributed shares and the homestead credit, and then the special legislation, CAGTs and COITs. So first, CAGT. As you know, the CAGT money is distributed by our office to your office monthly, and the CAGT distribution that we send, for the certified shares and property tax replacement, that distribution, if you've adopted any of the other special uses, such as the special legislation or the PTRC, homestead, or qualified residential PTRC, or levy freeze, or public safety, if you've adopted any of those, then that one distribution is going to include all of those. The part of the CAGT certified shares and property tax replacement credit, that part of the distribution you can put either in a separate distribution fund for each, or you can have one fund for both of those. But whatever the case may be, the distribution fund, it should have a zero balance at the end of every month and at the end of the year. The distribution fund, this is not your county CAGT fund, but this is the fund that you'll have where you'll receipt in the state distribution, and then within 10 days you're going to be making distributions out to the local units. And just as I said, you're going to quitus that our state distribution into that distribution fund. Now, I mentioned earlier in the earlier slide about that the CAGIT certified shares and replacement credit distribution. Included with that will be any of these other LOIT uses that you may have adopted, whether it's special legislation or if it's one of the LOIT property tax reliefs or the public safety or the levy freeze. And how you will know what part of the monthly distribution is each of those is going to be from the Auditor of State worksheet that we send to you at the time we send the January distribution. And what I'm talking about is that you get from us with the January distribution, you get 3 different PDF reports. One will show you the breakdown between of the certified shares, replacement credit, levy freeze, public safety, and the other uses. One will show you that breakdown for the total for the year. And then another one of the reports is going to show you the breakdown for the monthly distribution. And so if you're Brown County, the monthly distribution amount you got from us was the $429,000, and then the separate parts of that are these other columns. So the homestead credit part is that 110. The public safety is the 55,000. The levy freeze, the 44,000. Oops. And the certified shares and property tax replacement part of that was 220,000. So that tells you the individual amounts of that total monthly distribution, and those individual amounts you have to quitus into a separate fund. Right now I'm talking about the certified share part, but that's how you know what amount is what's what with the total monthly distribution. Then the third report that is sent to you gives you what the breakdown it will be for the December distribution, because the monthly distribution amounts will be the same from January through November, but December is always, or maybe chances are it's going to be different. The December distribution is where we make a rounding adjustment for the year, and we determine the December amount is determined by taking the total for the year, subtracting out the sum of the January through November, and leaving the remaining amount to be the December distribution amount. And that is so that we guarantees that we've distributed to your county the correct total for the year. So in January, we send out those 3 different reports, the total report, the monthly January through November, and the December, and we do that for each of CAGIT, COIT, and CEDAT. And so those reports are important to retain, because starting with the February distribution through the rest of the year, we will not send the reports again unless you request it. Obviously, we'll send it to you if you need it. But so the so within 10 days of receiving the distribution from the state, then you are to make your distribution to the taxing units, and excuse me, and you will make, you'll quitus in the state distribution to your distribution fund, and then you'll write the checks out of the distribution fund to the taxing units, and then at the end of the month, then that distribution fund should have a zero balance. The amounts you're going to distribute to the taxing units, those will be 1/12 of the amount that's shown on the DLGF Cadget report, which you should already have those for next year, but or they're out on the DLGF's website. But you will take that certified shares and property tax replacement credit amounts off of those the DLGF report, and 1/12 of that is what you'll distribute each month. Just like we do with the December distribution to you, your December distribution amount to the taxing unit is going to equal that DLGF report minus the sum of the January through November amounts. If a rounding adjustment is needed to be made in any one month or for the full year, I suggest you make that to the county amount. The rounding adjustment should be very, very small. It should be pennies, if any, rounding adjustments made. If you find that you're having to make a larger than minuscule rounding adjustment, then you need to recheck your computations. And if you're still having problems, just let us know and we'll help you with that. But to repeat again, the distribution fund should have a zero balance at the end of each month and at year end. Water. Moving on to the COIT distributive shares. Without the COIT homestead, this COIT distribution is very, very much the same as the Cadget certified shares and property tax replacement. And there's just very little difference between how that each of these work. You're going to have a separate distribution fund, and that distribution fund should have a zero balance at month end. If your county has adopted one of the other COITs, either any of those that are listed here, then that distribution from our office is going to include all those amounts. And to be able to determine what each amount is of the monthly distribution, you'll use our report that we send in January that gives you a column for each of the separate types of COIT that your county has, and you will use that to separate out that monthly distribution into the separate funds. And so this just is all basically the same as the Cadget certified shares. Once again, on determining the amount that you're distributing to the taxing units, that amount is going to equal 1/12 of the taxing unit amount that's shown on the DLGF COIT report. And once again, December is going to be the COIT amount on the DLGF report minus the sum of the January to November unit amounts. And if you need to make a rounding adjustment, I would make it to the county unit amount. There again, the rounding adjustment should just be pennies. And if it's more than that, you definitely need to recheck the calculations. And repeating again, this distribution fund should have a zero balance. And so on the county level, with the Cadget certified shares and replacement credit and with the COIT distributive shares, on the county level, you're going to have two either Cadget funds or COIT funds. One is going to be a distribution fund where the state distribution amount is quietest in, and the payments out to the taxing units, including the county, are made from that distribution fund. And then the county amount, you will then quietest into the county COIT or CAGIT fund, and that is the fund that you will maintain your money, and you will budget out of and expend the money that's been approved in the budget for the COIT or the CAGIT fund. And so you must keep the distribution fund and the county fund separate. If you don't have separate funds, I strongly suggest that you create separate funds, and because by having a distribution fund and the fact that it must have a zero balance, anytime that it doesn't have a zero balance, I mean at the end of the month, you know there's something amiss somewhere. And so that fund, the distribution fund, is only going to carry balance for hopefully no more than 10 days out of each month would there be a balance in there. See, what is there? 10 counties that have to pay attention now. The rest can not for just a couple minutes. I think it's 10 counties that have COIT with COIT homestead. This certainly adds a little twist to things. Whenever there is COIT homestead, then the twist is that not all of the state distribution that you receive is going to be distributed out to the taxing units. And you're going to hold back a portion of it for the funding of the COIT homestead. That portion of the state distribution that is held back for COIT homestead can either be put in a separate COIT homestead fund or left in the COIT distribution fund. You can do either. If you have separate funds, then the COIT homestead fund balance must be transferred to the COIT distributive shares distribution fund at year end, and the COIT homestead and COIT distributive shares distribution fund balance must be zero at year end. If you have a single fund, then the COIT distributive shares distribution fund balance must be zero at year end. But it won't be zero at every month during a year, only at year end. To accomplish having a zero balance at year end means that the distributions, the distributive shares distributions to taxing units cannot be made until after December settlement is completed. So at the beginning of the year, the amount of the monthly distribution that you're going to hold back for COIT homestead is based on the homestead credit amount that's on the DLGF COIT report, and the monthly distributive shares distributions to taxing units are based on the distributive shares amounts on the DLGF COIT report. Once the abstract is approved, then the monthly amount held back for COIT homestead is adjusted to the abstract COIT homestead, and the monthly distributive shares distributions to taxing units are adjusted. So at the beginning of the year, you start off with holding back for COIT homestead 1/12 of the homestead credit amount that's on the DLGF COIT report, and the monthly distributive shares distributions to the taxing units will be 1/12 of the distributive shares on the COIT, DLGF COIT report. Once the abstract is approved, then the estimated amount of the COIT homestead to be held back for the remainder of the year can be determined then, and the estimated amount to be held back for the remainder of the year will be equal to the abstract amount minus the COIT homestead credit that you've held back so far to date. And the new monthly COA homestead to be held back is that estimated amount divided by the number of months remaining in the year. And the new monthly amount distributed to the taxing units, new total monthly amount will be to the taxing unit is the state monthly distribution minus the new monthly homestead credit amount that's being held back. And then the new monthly taxing unit distributive shares amounts are calculated by multiplying an allocation factor times the taxing unit distributive shares amounts that are shown on that COA homestead or DLGF COA report. And that allocation factor is equal to the new monthly COA distributive shares amount divided by the total of the distributive shares on the DLGF report. There again, rounding adjustments I would make to the county amount. There again, the rounding adjustment should be very little. And then before the June settlement, you'll write a check equal to either 1/2 or 5/12 of the abstract COA homestead amount is written to the treasurer from the COA fund, and that the treasurer to include in the June settlement. And you give the treasurer a taxing district breakdown, and the breakdown is going to be equal to either 1/2 or 5/12 of the taxing district abstract amounts. And then in December, once again, before the treasurer certifies tax collections, check is written to the treasurer, and the equal to the abstract COA homestead amount minus the amount that was dispersed to the treasurer at June settlement and from the COA fund, and then the taxing district breakdown to the treasurer, and that taxing district breakdown is going to equal the taxing district abstract amounts minus the June settlement amount. Then at the December settlement, the homestead reconciliation worksheet is completed to determine if you need additional COA homestead. And if you need additional COA homestead, then a check is written from the COA fund, and the December COA distributed shares adjustments to taxing units are decreased proportionally. And then if there is excess COA homestead, then that excess is quietus to the COA fund, and those COA distributive shares distributions to the taxing units are increased proportionally. So the key there was, one is that if you don't have COA homestead, you're probably glad you don't. The other is that you must not make those December distributions to taxing units until you know where you're at with the COA homestead, or otherwise you could distribute too much money to the taxing units, and then you're going to have to try to get the money back. And so it's best just to hold up until you know what the homestead settlement's going to be. Now moving on to the LOIT. LOIT meaning both Cadgett and COA counties. One of the options is that you can adopt LOIT for property tax relief, and the property tax relief that can be adopted can be any one of the three options of property tax replacement, homestead, or the qualified res PTRC, or it could be any two of those three. Or it can be all three, but your options on which to adopt. If the county has adopted any one of those property tax relief credits, then that state distribution that we send to you each month is going to include that money along with the other COIT or CAGIT money that you may have adopted. And once again, how you're going to know the breakdown is to use the report that we send out in January, at the beginning of the year in January, that identifies the breakdown of the distribution. You must have a fund for each of those property tax relief credits that you adopt, and the monthly distribution, state distribution, must be quitted directly to the property tax relief fund. And the property tax relief is not distributed directly to the taxing units. It is included in the property tax distributions at settlement. Key here is, and one of the things we find that's still not happening, that must happen, is that there must be a separate fund for each of these credits. If your county happens to adopt the LOIT for property tax relief, and if they adopted a rate for each one of the three, in other words, they've adopted all three of the options, then you've got to have three funds, because your distribution that you get from the state is going to include money for each of those, and we are going to tell you how much of that monthly distribution is for each, and that money must go into the separate funds. This is an area where we're still having trouble with, and finding out that there aren't separate funds. What you're going to do with the money is you're going to be calculating a property tax credit that's going to be used in the calculation of the property tax bills, and those property tax credit amounts are going to be included on the abstract. And we provide to you worksheets to calculate those credits. And once again, if your county has adopted all three of those, if you adopted homestead and replacement credit and qualified res, we will provide you 3 different worksheets for each of those, and the assessed value and tax calculations to calculate each of those credits is going to be different. And you're going to need to know how much money you have in each of the funds. And here's a point, here's an example of, you got to have a separate fund because you need to know what the beginning balance of the fund is, and so you need a separate fund. So then before the treasurer, so you're putting the money in the fund as you go along through the year. Then before the treasurer certifies June settlement, the check, either can be either 1/2 of the abstract, or you can make it 5/12 of the abstract amount, is written out of the fund to the treasurer, and the treasurer will include that in the tax collection certification, and you will include that money in the June settlement. Then again for December, the same process. You will write a check out of the fund to the treasurer, and the treasurer includes it in December settlement certifications, and you will include it in the December settlement. The little twist in December is that there is a reconciliation worksheet to complete to determine whether or not there is additional LOIT homestead or LOIT res PTRC needed, or if there is an excess. There's also, if you have the property tax replacement credit, there's a reconciliation worksheet to prepare for that, to determine if there's excess or if you need more property tax replacement money. If more money is needed, then a check is written out of the fund to the treasurer, and if there is an excess, then the money is quieted into the fund at settlement. The balance in the fund remains in the fund to be used in the following year. So with these credits and this LOIT money, it is okay, and it is expected that the fund is going to have a balance, either positive or negative. You hope it's positive, but there are times where there have been so many changes with tax bills that there was more money needed and it put the fund into the red. And if that occurred, then the following year in calculating the credit rate, that's going to be taken into consideration. And so the following year, the credit rate would be lower than it would otherwise be if there wasn't a negative balance. But whatever the balance is, it stays in the fund. You don't move it from that fund to another fund. You have separate funds for each credit that the county's adopted, and it stays in the fund. The one question that has come up here is, okay, my county council this year, they have decided that we're no longer going to have a homestead credit, and they've lowered our income tax rate and eliminated the homestead credit. What do we do with that fund balance? Well, you're not going to do anything with that fund balance because you're going to have years going forward where you will have tax refunds and corrections and the like, and you're going to be doing the reconciliation at the end of at the December settlement, and you may need more money to take from that fund and that balance. So you don't immediately do anything with the balance. And even if your county has, say, adopted to change from a homestead credit to a res PTRC, we're no longer going to have homestead, we're going to have res PTRC, still leave the homestead credit fund alone, out at least 3 years for all the refunds and corrections to flow through and take care of it. Now, coming into the new year, since you haven't adopted money for that particular credit, you won't be putting any more money in it, but you'll just leave the balance as is for a few years. Now here's where the goof happened. This is page 12. You right now in the handout you do not have this slide. You have a repeat of the next slide. But there are the corrections up here for this. But the LOIT levy freeze, this isn't corrected either. Of course it isn't, because this came off of the State Board of Accounts website. Well, I was not thinking there, was I? What that should say is that sort of like the levy, not sort of, it's almost identical to the property tax relief slide, introduction to the property tax relief slide. What this slide should be telling you, and the correction does tell you, that either Cadgett and Coet counties can adopt the LOIT for property tax levy freeze. And if your county adopts that, then the state monthly distribution will include that money, and the way to determine what portion of that state distribution is the levy freeze money is from the January report, the report we send out in January that gives you the breakdown of the total of monthly distributions, this amount, and of that amount, this amount's levy freeze. And that's how you get the breakdown for that. Then we move on to this slide. And here I'm telling you that like all the others, it's kind of like a broken record here. It's like with all the other LOITs, you must have a state, a levy freeze fund. You must have a separate fund, and that you will, a distribution fund for the levy freeze, and and DLGF will provide to you the levy freeze certification and the equivalency rate report, and that report lists each taxing unit that's to receive a distribution and the levy type. And you are to distribute that money to those taxing units within 10 days of receiving the state distribution. The format of the levy freeze report is that it has the taxing unit DLGF number, the name of the unit, and that's going to receive a distribution. The levy type, most of them are general fund. Then the first column is what is the full levy freeze amount. And then it gives you the equivalency rate. And then the next column is the levy freeze amount to be received in state distribution. So this is that portion of the state distribution that you get, the amount that's for the levy freeze. And then the last column is a difference column. And the difference column is the difference between that full levy freeze amount and the amount that you're going to be receiving in state distributions. If that difference column is a positive number, that's a good thing. That means that you're getting you're getting more in state distributions than the full levy freeze amount, and the difference you'll be quieting in to the levy freeze stabilization fund. If the difference column is a negative amount, then the difference then that means that the amount of the levy freeze distributions to taxing units, that is the amount of the levy freeze distributions to the taxing units to come out of the stabilization fund if there is sufficient money in the stabilization fund. So what this means, if it's a negative amount, that means that the current distributions that you're getting from the state, it's not enough to distribute to the taxing unit the full levy freeze amount. And you need to supplement it by taking money out of the stabilization fund. But if there isn't sufficient money in the stabilization fund to cover the negative amount, then the full levy freeze amount cannot be distributed to the taxing units. Your total levy freeze distributions for the year cannot be more than the money you have available for the levy freeze distributions. And the money available for levy freeze distributions is the total of the amount in the stabilization fund plus the total levy freeze state distribution in the current year. And so if the difference column of the DLGF levy freeze certification report is negative, then the calculation of the levy freeze money available for levy freeze distributions must be done before the first levy freeze distribution is made. And if there's insufficient levy freeze money available to distribute the full levy freeze amount, then each taxing unit's levy freeze distribution will equal the total levy freeze amount money available for distribution prorated by the full levy freeze amounts. In other words, if you get your levy freeze report and you're seeing negative in that last column, the very first thing you need to be doing is taking a look at the money in the stabilization fund plus the money you're going to get for the current year in levy freeze, and seeing if those two amounts equal the total of that first column of the report, the full levy freeze. Must do before you ever start the year out, or else you'll get down around October, November or so, and you go to write the check, and you'll say, oh, the checking account is empty. And we didn't let anybody know before we started this year that the checking account was going to be empty. The taxing units have got to know this. Hopefully you've been looking at this in the summertime when you're put to make the decision as a levy-freeze county. You're put to make the decision is, do we continue with funding the next year's levy increase with the income tax? And if we do we need to raise the income tax rate, or are we okay for one more year with leaving the income tax rate it is? Or do we need to decide, we being either the county council or the county option income tax council, do we need to decide to do what they call thaw the levy? In other words, next year the levy increase is going to come from property tax, or do we make, as a council, do we make the decision that we're not going to increase income tax, and we're not going to switch over to property tax, and we're fully aware of next year we can only fund 80% of the levy freeze amount? And as a council, I think you owe it to the other taxing units to inform them that that's a decision you made, that because they're not going to get their full levy increase because you're only going to send them 80% of that. And these are all things that you need to be thinking about and considering in the summer and the early fall. But regardless of what the council does, you as the fiscal officer and as making the distributions, you need to, at the beginning of the year, if you see the old negatives in that final column, you need to be looking ahead to see, okay, are we going to be okay this year? I mean, even though that's negative, we're going to have enough money in stabilization fund to take care of that. We're going to be fine and dandy. They're all going to get their full levy. Or are they not going to get their full levy? And if they're not going to get their full levy, then, you know, you need to make everybody, the councils and the taxing units, make them aware of that the distributions are going to be 90% of the total and not 100%. And so you got to look at this. Because a lot of the levy-freeze counties are getting to this point because they haven't made changes in income tax rates, and they're continuing to decide to do the levy freeze one more year and one more year. And it just becomes an impossibility to keep doing that without making either thawing the levy and going back to property or to raise income taxes. It's just the simple math of the public safety. As far as I can tell, I think I got these slides okay. The Cadgett-Coet counties can adopt a public safety rate. If you do, then the monthly distribution is going to include it. And there again, you can identify what part of the distribution is public safety from our report that we send to you. A separate fund must be maintained. The distribution must be quieted directly to that distribution fund. DLGF provides each of the counties a public safety distribution report listing the units that are eligible for a distribution and what the potential distribution amount is. And then you as county auditor have 10 days from the time you receive the state distribution to distribute the money out to the public safety or out to the taxing units. One thing back on that, you as a county unit, you're going to have two public safety funds. You need to have a public safety distribution fund where the state distribution goes in and the payments out to the taxing units, including the county, go out of that fund, and then the county's public safety money goes into a separate public safety funding that is the county's fund. And that fund will carry a balance, and you'll distribute the money budgeted and so forth. The public safety distribution fund should be carrying a zero balance at month and year end. One aspect about public safety is that before July 1, Each of the fire departments, volunteer fire departments, and/or the emergency service providers may apply to the county council in Cadgett counties and the income tax council in the COIT counties. They can apply to receive some of the LOIT public safety funds in the following calendar year. And these are the volunteer fire departments and the fire departments of taxing units or associated with taxing units that aren't already getting a share of the public safety money. And so these are your townships, basically. The council, they're required to review the applications, and they may, before September 1, adopt an ordinance to approve the distribution of the LOIT public safety to one or more of those applicants. The ordinance has to specify the amount, and this is only valid for 1 year. The application and approval process is an annual event. So the county council and the income tax council, they're obligated to review the applications, but they're not obligated to approve them. They can decide to either to grant funding or not. And if they do approve a distribution to one or more of those eligible entities, then those distributions are made first, and whatever amount that you distribute to in total to those entities, whatever amount that you do distribute to them, then you're going to reduce the amount you distribute to the units that are on the DLGF report, and you'll reduce those proportionally. In other words, if 20,000 or 200,000 is being distributed in total to those entities, and the county's share of the total amount distributed is 40%, so then 40% of the 200,000 goes towards reducing the counties, and then if one of the towns is 10%, then 10% reduces the town, and so forth and so on. But every month end and year end, the public safety distribution fund should have a zero balance. Seated distributive shares operates just like Cadgett and COIT with the distributive shares. We distribute to the county monthly. You need a separate distribution fund, and the distribution fund should have a zero balance, and you have 10 days to make the distribution. The distribution to the units is going to be 1/12 of the amount on the Cadgett seated report, and then the December amount is going to be the total on the DLGF report minus the sum of the January to November distributions and rounding adjustments. I suggest you make it to the county amount. And the distribution fund, once again, stating this again, should have a zero balance. Seated homestead, we distribute that to the counties monthly. You should have must have a separate fund for that, and the state distribution is quiets directly to the fund. The year-end balance in the seated homestead credit fund remains in the fund to be used toward the next year's rate calculation. You don't distribute this directly to taxing units. It's included in the property tax distributions. We have a calculation worksheet for you to use and to calculate the credits. And you're going to write a check from that fund to the treasurer before June settlement certification, and that check can be either 1/2 of the abstract or 5/12 of the abstract amount, and you'll give them a district breakdown that's based on the abstract. December, do the same. December amount is going to be the abstract amount less the June amount, and then in December, there's the homestead reconciliation to determine if you need additional seated homestead or if you have an excess. And if you need additional homestead, you'll write a check. If there's excess, you're going to quitus it into the homestead fund. The thing I didn't mention, this is one of the areas of difficulty at December settlement a lot. No, well, I shouldn't say a lot, but it is somewhat. And what I'm about to say here for seated homestead applies to the Cadget and COIT, PTRCs, and homestead and residential credit. The one of the checks one of the amounts of money that gets overlooked at settlement time is the check coming out of the Homestead Credit Fund when additional money is needed. Sometimes treasurers want to argue the point that they don't need the additional money, but they do. And then there's sometimes question about what to do with the excess. And so many times whenever the treasurer comes up short with money on settlement, or the treasurer has money left over at settlement, a lot of times it goes back to this right here, where a check wasn't written out of the fund to the treasurer, or a quietus to the fund wasn't made. And so this is always the first thing that, if we get a question about settlement not balancing, this is one of the first areas we look at. Then the special distributions, we distribute that money to the county every month. If you're one of the counties that has a special legislation distribution, your monthly distribution check includes that money, and you must have a separate fund for that special legislation money to be maintained. And once again, our report that is sent at the beginning of the year gives you the breakdown, and the special distribution money is dispersed in accordance with that legislation, so that varies quite a bit. And those funds, whatever the fund balance is in one of those funds is going to remain in the fund for the future expenditures. That concludes that presentation. If there are any questions?